Alright, so this is a key example for financing a home. Pause and take a second to read the entire problem. I'm going to jump right in. So they've borrowed $120,000. That's the amount financed. That's the present value. The interest rate is 9%. And it says that they're doing a 30-year mortgage and it's compounded monthly. So the N is 30 years times 12 months per year. So you actually make 360 total payments, 360 compoundings. We want the future value to be 0 because we want to pay this thing off. So we have to solve for the payment. So the amount of each payment, we hit alpha solve, and that gives us 965, 55 actually. So how much total was paid for interest? So the amount for payment is just this number here. Total amount paid is going to be 360 times that monthly payment, right? Because they write a check for 965.55 360 times. That results in $347,598. So that's the total they paid over the course of the loan. We need to subtract their original, what the actual principal value was, which was $120, and that leaves you with $227,598 in interest. So almost double the amount that they were actually taking out for a loan is paid for interest. Alright, so now what if they went with a 15-year loan instead? Certainly their payment is going to go up, but maybe it's worth it. So let's check that out. So if they went with a 15-year payment, the only thing that's going to change is, before we solve, is this is now a 15 instead of a 30. So 15 years times 12 months, that gives you, why isn't that working? Okay, that gives you 180 compoundings in total payments. So now we go down to figure out what their payment must be, and that's going to be about less than $300 more, around $250 more per month. So just paying that $250 more per month. Okay, why won't that drag over? All right, awesome, whatever. So that's going to be, so our result is that monthly payment times 180 payments is $219,081. $219,081.60. If we subtract the 120, that figures out the total interest. So minus 120 grand leaves us with 99,081.6. So that's still almost $100,000 in interest, but it's 130,000 or so less in interest than if we went with the 30-year loan. So you see, you save a lot of money in interest by shortening the term of your loan. Both of these interest payments are pretty high, and that's because it's a 9% interest rate. So if we could adjust the interest rate, that would also reduce the total we'd be paying over.